Assalamu alaikum and good day everyone. Today, the topic that was assigned to us and will be presenting to you is entitled The Liabilities. Together with me are Mamalampak Muhammad Anzala, Mandangan Abdul Hakim, yours truly, Sampal Abdul Rauf, and Tabu Asnor. So today's presentation will be presenting to you the intro and recognition of liabilities, the measurement of liabilities, the recognition of liabilities, the provision and its measurement and reimbursement, the contingent liabilities and the contingent assets, and lastly, the application of the recognition and measurement rules. Liabilities. So for today's objectives, first is to state the recognition criteria for liabilities. Second, to state the initial and subsequent measurement of financial liabilities. And lastly, to state the measurement of provisions, contingent liabilities, and contingent assets. So what is liability? Liability, accordingly, it is a present obligation arising from past event, the settlement of which is expected to result in an outflow of resources, embodying economic benefits or service potential. When we say present obligation, or first things first, when we say liabilities, these are present obligation of an entity arising from past transactions or events. So the settlement of which is expected to result in an outflow of resources in which it embodies economic benefits. Now, what is present obligation again? So, liability though is a present obligation of an entity. So, the entity liable should acknowledge its existing obligation to a particular payee, whether the latter is identified or not. Now, an obligation is a duty or responsibility to act or perform in a certain way. This may be legally enforceable as a consequence of a binding contract or statutory requirement. So how about the obligating event? So an obligating event is an event that creates either a legal obligation or a constructive obligation. So a transaction or event that will give rise to a liability should occur first prior to the recognition of an item as a liability. So there should be an occurrence of the transaction in order for the recognition of a specific item to be a liability. Again, so the past event that gave rise to the present obligation is termed as obligating event. Now, accordingly, an obligating event creates a legal or constructive obligation because the entity has no realistic alternative but to settle the obligation. So what is legal obligation and constructive obligation? So legal versus constructive obligation. So legal obligation is an obligation arising from, it could be contract, legislation, or other operations of law. Meanwhile, a constructive obligation is an obligation that results from an entity's actions that create a valid expectation from others that the entity will accept and discharge certain responsibilities, which means that the obligation that is derived from an entity's action where the entity indicated to other parties that it will accept certain responsibilities by reason of established pattern of past practice, published policy, or sufficient current statement. It could also result that the entity has created a valid expectation on the part of other parties that it will charge its responsibilities or those responsibilities. Now that is constructive and legal obligation. Moving on, when is liability recognized? So accordingly, a liability is recognized when all of the following are met. First is the item meets the definition of a liability, which is a present obligation. First, second, arises from a past event. And those are the two that meets the definition of liabilities. And second is it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. So what do we mean by this is that there is a probability that an outflow of resources embodying economic benefits will totally result from settlement of the present obligation. And lastly, the obligation has a cost or value that can be measured reliably. So the amount at which the settlement will take place can be measured reliably. So under PFRS 9, financial liabilities are recognized on the statement of financial position when the entity becomes party to the contractual provisions of the instrument. So those are the criteria in recognizing liability. Moving on, we have now the financial liabilities. So what are financial liabilities? There are also non-financial liabilities, but we will discuss first the financial liabilities. So a financial liability is a contractual obligation to deliver cash or another financial asset to another entity. So it only means that it is a contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. Another thing is a contract that will or may be settled in the entity's own equity instruments, which could either be derivative or non-derivative instruments. So when we say a contract that will or may be settled in the entity's own equity instruments and is classified as either non-derivative or derivative instruments is, for the non-derivative, it only means that for which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments. And for the part of non-derivative instruments, it is a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial assets for a fixed number of the entity's own equity instruments. So what are the examples of financial liabilities? We have here the most common one, the accounts payable, the utilities payable, the accrued interest expense, the bonds payable, the security deposit. There are also the cash dividends payable, the financial lease liability, and so on. So how about the non-financial liabilities? So in this criteria, other liabilities that did not meet the above requirements are considered as non-financial liabilities. So what are the examples of non-financial liabilities? We have here the advances from customers, the unearned rent, the warranty obligations, the income tax payable, the SSS contribution payable, the full health contribution payable, the deferred tax liabilities, the provisions for warranties, and so on. So those are the financial and non-financial liabilities. Moving on. So what is the initial measurement of financial liabilities? Financial liabilities are initially measured at either fair value or fair value minus transaction cost. Except for financial liabilities at fair value through surplus or deficit, which transaction costs are already expensed or expensed. So first things first, what is fair value? When we say fair value, it is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So for fair value, financial liability is determined through order of priority. Number 1, the quotation from an active market. Number 2, present value of all principal and interest payments. So that is what you mean by fair value. But how about the transaction cost? Transaction costs are incremental costs that are directly attributable to the acquisition, issue, or disposal of a financial instrument. So when we go back, incremental cost means that it's one that would not have been incurred if the entity had not acquired, issued, or disposed of the financial liability. So that is what we mean by incremental cost. So what are the examples are included in the transaction cost? We have here the fees and commission paid to agents, advisors, brokers, and dealers, levies by regulatory agencies and security exchanges, transfer tax, and duties. So those are the measurement In the financial liabilities, it is either fair value or fair value minus transaction cost. Moving on, the next reporter will be discussing to you the recognition of financial liabilities. Thank you. Wassalam.
Assalamualaikum warahmatullahi wabarakatuh. I am Asnor Istabwat, second reporter of this group. So Sirad already started discussing the measurement, which he discussed the initial. So for my part, I will be discussing the subsequent measurement. So financial liabilities are subsequently measured at amortized cost. So yung amortized cost, I think lahat naman tayo familiar, but bibigyan natin yun ng illustration. Except for financial liabilities at fair value through surplus or deficit, which are subsequently measured at fair value. Now, for illustration, on January, itong illustration natin nandito na yung initial measurement and subsequent measurement. On January 1, 2021, the BTR issues a 5-year, 5%, 1 million pesos bonds for 970,000 pesos. Now, itong 1 million is the face value. Pag nag-issue si BTR, yung nakalagay sa certificate, yan, 1 million pesos. Kumbaga yan yung face value. Now, binili ni investor sa halagang 970,000 pesos lang. Therefore, nagkaroon ng discount. Yung difference na 1 million, yung difference ni 1 million at 970,000 pesos na 30,000, yun yung i-amortize natin throughout the years. Ibig sabihin, pag nag-amortize tayo after 5 years, yung 900, yung present value magiging 1 million. Okay, so transaction cost on the issuance bond issue cost amount to 12,124. The effective interest rate adjusted for both the bond discount and bond issue cost is 6%. So itong 5% yan yung stated rate, yan yung nakalagay talaga sa certificate, yan yung nominal rate. Itong 6% yan yung gagamitin natin in computing the interest expense na ipapakita natin sa amortization table. Okay. So, pwede natin ma-compute yung present value or the carrying amount of the bonds using this format. Okay, so we have here the face amount, 1 million. You have to deduct the bond discount. Yung bond discount, 1 million minus 970,000. Okay, minus natin yan. And bond issue cost. So, yung bond issue cost are not expense outright, but rather a deduction when determining the carrying amount of the bonds. Similar also sa bond discount. Pinakita lang dito na ima-minus yung bond discount, but pwede natin siya i-diretso using this formula as well. So, net issuance proceeds. Yan yung natanggap ni BTR na pera galing kay investor. Diretso na siya. Then, you have to deduct the bond issue cost. Yung bond issue cost, as I've said, are amortized to interest expense over the term of the bonds, together with any bond discount or premium. So, yeah. Pag bond discount, ipa-plus yan sa carrying amount sa subsequent years. Kasi nga, di ba ito, from carrying amount, dapat maging 1 million yan. So, kailangan natin i-plus yung mga na-amortize natin. Okay? So, para mas maintindihan natin yung amortization, i-journal muna natin in the next slide. Itong na-solve natin na carrying amount. Itong transaction na to. Okay, so how do we journal the transaction? Okay, so tulad na pag-journal natin sa mga sa service concern, kumbaga. Kasi nasa point of view tayo ni BTR, ngayon, may papasok na pera. So, ibig sabihin, yung papasok na pera, mag-increase yung cash asset natin, so cash in bank, local currency, Bangko Sentral ng Pilipinas. Kasi dito lang i-issue yung bonds sa atin, sa Philippines lang. So, we have 970,000 pesos, yan yung binigay ni investor. Then, we have credit na bonds payable domestic 1 million pesos. So, the difference is the discount. Since mas malaki yung mas maliit yung nabigay sa atin, ibig sabihin nagkaroon ng discount. If mas malaki yung binigay sa atin compare sa face value ng bonds, ibig sabihin magkakaroon ng premium. So sa illustration natin, mas mababa, so magkakaroon tayo ng balancing figure na discount on bonds payable domestic. Okay? So para sa pag-record ng bond issue cost by the BTR, we have here the debit na bond issue cost domestic, and of course, mayroon gagamitin, may lalabas na pera si BTR, cash in bank, local currency, basically. Kasi yan yung mga direct attributable cost sa pag-process ng pag-issue ng bonds. So yung bond issue cost are amortized to interest expense. So the amortization of bond issue cost increases interest expense. Okay, so para mas maintindihan natin yung makita natin yung flow ng amortization table, let's proceed to the next slide. So we are down to amortization table. So this is the format of the amortization table. We have here the date, the interest payments, interest expense, and the amortization, and the present value. Now, yung interest payments, wala tayong problema dyan. Kasi meron na tayong fixed na yan. It is computed as face value times the nominal rate, yung stated rate, yung nakalagay talaga sa bond certificate na 5%. So 1 million times 5%, we have 50,000 pesos. So same lang yan throughout the years. So yung interest expense computed as present value, the carrying amount, times the effective rate, 6%. So the difference of interest payments and the interest expense is the amortization. So as I've said, pag nagkaroon ng discount, ibig sabihin, ipa-plus natin yung amortization sa carrying amount. So 957,876 pesos plus the amortization, makukuha natin yung carrying amount as of December 31, 2021. Now, the process sa December 31, 2022 is quite similar. So, walang problema doon. So, para mas simplify itong illustration natin, yung withholding taxes on interest payments are omitted. Okay, so same lang yung process dito. Minsan dito, balancing figure na lang yung nangyari, but i-try ko i-multiply itong present value ng December 31 or the beginning carrying amount of 2025 is same din yung lalabas. So pag hindi siya same, kadalasan, balancing figure na lang yung nangyayari. Okay? Okay, so yung adjusting interest natin for interest expense. Sa IA1, nakasanayan natin na i-separate yung interest expense dun sa interest payment. So dito, gi-compound na siya. We have here the ito yung interest payments na fixed na 1 million times 5%, di ba? So pag i-manual, separate natin yan, interest expense, debit, 50,000, then credit, cash in bank, local currency, BSP na 50,000. Tapos yung amortization, interest expense na 7,473 pesos, tapos yung allocated sa discount and bond issue cost. But since same naman sila ng debit side, why not na i-compound na lang natin. Ipapakita natin yung paano na allocate yung 7,473 kasi di ba na mention natin yung bond issue cost is ina-amortize yan, nag-i-increase yan ng interest expense. Pero if premium to, hindi ito mag-i-increase ng interest expense, ipapaliit niya yung interest expense. But since itong illustration is a discount, so it will increase the interest expense. So, paano nakuha yung 5,322 na allocated kay discount on bonds payable? Okay, so di ba meron tayong carrying amount na bond discount na 30,000, tapos yung bond issue cost na 12,124 pesos with a total of 42,124 pesos. So, the allocation of amortization is ganito. We have 7,473 times the 30,000 divided by 42,124 para makuha natin yung allocated kay bond discount. So, same process kay bond issue cost, meron tayong 2,151 pesos. Then, makukuha natin yung total amortization na 7,473 pesos. So, yun. Paano nakuha yung allocated kay discount at saka yung allocated kay bond issue cost. Again, yung bond issue cost is always nag-increase ng interest expense. Yung dito nagkataon lang ng discount kaya nag-increase, but if premium mag-decrease yung interest expense. So that's for the amortization at the end of the period. So same process lang sa 2022. Okay, so we are down to the recognition of financial liability. So a financial liability is recognized when it is extinguished. Pag wala na, so tapos na, 'di ba? So tulad ng pag na-discharge, pag na-waive, pag na-cancel. Okay, so sabihin natin sa 3 years sa 3 years niya na-cancel, so wala, i-extinguish na natin, i-derecognize na natin or na-expire. So pag tapos na yung 5 years, sa illustration natin 5 years lang. So pag dumating na tayo sa 5 years, so wala na. 'Di ba? I-extinguish na, i-derecognize na. So that's for my assign. I hope you learned something. Thank you.
So, Assalamu alaikum and good day. I am Abdul Rauf Ali Bakaraman Sampal, and today I will be discussing all about provisions, its measurements, and reimbursements. So first, alamin muna natin kung ano ang meaning ni provision. So according to IAS 37, a provision represents funds put aside by an entity or a company to cover anticipated losses in the future. So in short, it is a liability of uncertain timing or uncertain amount. So moving on, businesses cannot simply record a provision whenever they see fit. It is only recognized kung ang criteria for being a liability has been met. So these are, number one, an entity has a current obligation arising from past events. Number two, it is probable that an outflow of funds will occur during the settlement of the obligation. And number three, a company can make a reliable estimate of the amount of the obligation. Tandaan natin, if one or more criteria are not met, the item is considered or will be considered as a contingent liability and not a provision, and therefore it should not be recognized as a liability. So, para mas maintindihan natin, let me give you an example of a provision. So, an example of a provision is a product warranty. So consider a manufacturer that offers a warranty to a customer for one of its product. So the product warranty ay isang term in a contract na nandoon yung or nagsuspecify ng mga conditions under which the manufacturer will compensate or ang manufacturer ang magbabayad for any good that is defective without additional cost to the buyer. So, with that being said, the warranty falls under the definition of provision because the warranty is a possible future liability of uncertain time and amount. So now, let us move on to the measurement of provisions. So, provisions are measured at the best estimate, which we should be taking into account the risk and uncertainties of the expenditures required to settle the obligations. So, since uncertain yung timing and normally in-estimate lang natin kung kailan natin babayaran yung provision, asahan mong minsan kailangan natin i-involve yung time value element. So therefore, we have to compute for the present value of the obligation. So first, ano nga ba yung time value of money? So the time value of money iterates that the value of money few years ago is not same as today and few years from now. So maaring noon maliit yung value ng money, today pwedeng malaki or maliit yung value ng money. So if the effect of time value of money is material, the provision is measured at the present value of the settlement amount discounted at a pre-tax rate. So tandaan natin palagi na pre-tax rate ang gagamitin natin as a discount rate to reflect the effect of the time value of money. So another thing, tandaan natin na gains from the expected disposal of assets shall not be taken into account in measuring a provision. Another one, a provision shall be used only for expenditures for which the provision was originally recognized. So, hindi pwede na gamitin natin yung provision for other expenditures which hindi yun yung recognized provision niya. We should also take into account that provisions shall be reviewed at each reporting date and adjusted to reflect the current best estimate. So, if it is no longer probable that an outflow of resources embodying economic benefits or service potential would be required to settle the obligation, so pwedeng or we should reverse the provision. So moving on to the last part of my report, we have reimbursement. So if another party is expected to reimburse the settlement amount of a provision, yung reimbursement asset ay i-recognize and presented in the statement of financial position separately from the provision. So, yun nga, tatandaan natin na yung reimbursement should be recognized as a separate asset and not as a reduction of the required provision when and only when it is virtually certain that the reimbursement will be received if the entity settles the obligation. However, in the statement of financial performance, the expense related to the provision may be presented net of the reimbursement. So palaging natin tatandaan that the amount recognized should not exceed or hindi dapat mas malaki kaysa sa amount of provision.
Assalamu alaikum and good day everyone. My name is Muhammad Anzala Mamalampag and my report is all about the contingent asset and the contingent liability. So let us discuss first the contingent liability. So what is contingent liability? So contingent liability is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity, or the contingent liability is a present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits or service potential will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. So, ang ibig sabihin, a contingent liability is a liability or a potential loss that may occur in the future depending on the outcome of a specific event. For example, the potential lawsuits, product warranties, and pending investigations are some examples of the contingent liability. Contingent liabilities are possible obligations whose existence will be confirmed by uncertain future events that are not wholly within the control of the entity. An example is litigation against the entity when it is uncertain whether the entity has committed an act of wrongdoing and when it is not probable that the settlement will be needed. Contingent liabilities also include obligations that are not recognized because their amount cannot be measured reliably or because settlement is not probable. Also, contingent liabilities do not include provisions for which it is certain that the entity has a present obligation that is more likely than not to lead to an outflow of cash or other economic resources, even though the amount or timing is uncertain. A contingent liability is not recognized in the statement of financial position. However, unless the possibility of an outflow of economic resource is remote, contingent liability is disclosed in the notes. So let us move on the contingent asset. What is contingent asset? It is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. So, the contingent assets are not recognized, but they are disclosed when it is more likely than not that an inflow or benefits will occur. However, when the inflow of benefits is virtually certain, an asset is recognized in the statement of financial position because that asset is no longer considered to be contingent. So, andito yung summary of the contingent liability and the contingent asset. We have the contingent asset sa probable, contingent liability sa probable is recognized and disclosed, sa possible, disclose only, while the remote is we will ignore. While the contingent asset in the probable is we will disclose only, in the possible we will ignore, and sa remote ignore natin. So that could be all. Thank you.
Good day or afternoon to each and everyone, and Assalamualaikum. I hope this video discussion finds you well. I am Andangan Abdul Hakim and I will be discussing the application of the recognition and measurement rules. First is yung future operating net deficits. In this case, no provision shall be recognized for expected net deficits from future operating activities. Such expectation indicates that certain assets used in these activities may be impaired. and these assets shall be tested for impairment. As for future operating deficits, no provision shall be recognized. Why? Because the net deficits coming from future operations did not meet all the criteria in order for it to be recognized as a provision, and that is not a present obligation. Yes, it can be reliably measured, and an outflow of economic resources is probable, but it is not a present obligation, which is one of the criteria needed in order for it to be recognized as a provision. So this future operating net deficits only indicates that some assets used in the operating activities may be impaired lang, kaya testing of assets for impairment will only happen. The next one is the onerous contracts. So a contract is deemed onerous if the unavoidable cost of settling the obligation under the contract exceeds or outweighs the economic benefits expected to be received from it. Additionally, obligation under an onerous contract is recognized as a provision. So, yung onerous contracts happen when yung obligation natin is mas malaki compared sa kung ano yung benefits na makukuha natin. So, yung sobra doon is recognized as a provision. Next is restructuring. For restructuring, it is a program that is planned and controlled by management and materially changes either the scope of an entity's activities and the manner in which those activities are carried out. So restructuring is actually an action taken by a company to significantly modify the financial and operational aspects of the company. Usually when the business is facing financial difficulties where they have to change the terms because the company is incapable of paying the obligation according to the original terms, thus making them change the terms. This also involves significantly modifying the debt, operations, or the structure of a company as a way of limiting financial harm, and improving the business. Another example is kapag merong restructuring na nagaganap is when there are changes in the structure of management. So paano natin malalaman kung ito ay legal obligation ba? So there exists a legal obligation to restructure if at the reporting date the entity is under a contract that binds them into an agreement that makes them committed to sell or transfer operation. Also, walang obligasyon na mangyayari not until the entity is committed to the sale or transfer. Next is yung constructive obligation. So, constructive obligation to reconstruct exists when at the time of reporting period, there is a detailed formal plan for the restructuring. At the same time, the plan is known to those affected by it. So, a constructive obligation arises from the entity's own actions with the intent of making others know that the entity will accept certain liabilities. An example of this is kapag may warranty obligations. Now, ano ba yung involved na cost in restructuring? So, a restructuring provision includes only the direct costs resulting from from restructuring, and it does not include the cost associated with the ongoing activities of the entity, the retaining or relocating continuing staff, and lastly, yung marketing or investment in new systems and distribution networks. And that would be all for my part. Thank you for listening.